this one. Hello? Okay, you guys should be able to hear me now. You should be able to hear me now. You should be able to hear me now. You should be able to hear me now. Let's hope that you can hear me. If you can hear me, give me a quick thumbs up. Okay, perfect. Haha. All right, let me rewind. Welcome in. Sad that you guys didn't hear the first 5 minutes of music. I was playing some kick-ass music, but I'm glad that you guys made it here. Good morning, good evening, wherever you are, into this day trading mastery webinar, where we're gonna go over, how we can further enhance our toolkit and skill sets in these new environments. The market has been very, very interesting as of lately, and we're going to go over what has happened, what is about to happen, and then I'm also going to highlight some important things about day trading in general, specifically for scalps day trading and swing trading. So we'll be covering a lot of those topics today. I will also be going over some of the US macro market updates so that you guys have a good idea of what is about to happen. So I'll be going over the agenda in just a second. But very quickly first, I wanted to go over a little bit about myself, why you should be listening to me, what credibility do I have to even be guiding you or leading you in this journey if you are on the journey of day trading, right? So my name is Tushall, and I'm the founder of Everyday Growth Advisors, which is a investing and trading education and mentorship program. We are a private school. I built EGA from the ground up about 2 years ago, and this is our third year where we are actually trying to disrupt education in the way that the way that people actually learn. Majority of traditional schooling has been all about mainly just focusing on learning but never applying, and that's something that I always felt very annoyed with, the fact that we never ever focus on the ideas and then applying them in real world scenarios. So EGA was born out of that desperation to help day traders, especially since I've been in this industry for about 10 years now, investing and trading. Of course, been through one financial crash, which is the 2008 financial crash. I saw the whole thing unfold, and even though I wasn't trading much during that time, I definitely felt the shock waves. And now, I'm not considering the COVID crash. I would have been through two crashes at this time, right? So I've been around the block a little bit, and I can sympathize with traders that have just joined the stock market, because in 2020 and 2021 we had a very big rise of day traders having interest in trading and joining these markets because they had a lot of free time on their hands. And then now in 2022, as this market is starting to have a little bit of a correction and a little bit of revaluation, a lot of traders are struggling. In fact, this is probably one of the times when traders are going to be very prone and susceptible to blowing up their accounts, and this is when you need to be extremely prudent with your risk management and those additional things that will really set you apart. Okay. Additionally to that, I just graduated with my master's in honors masters from St. Mary's College just about 6 to 8 months ago, a little bit towards the end of last year. And I'm also doing my CFA level 1 within the next summer. All right. I currently manage a hybrid stock and options portfolio, in case you guys don't know, and we do it live on the Discord. We have a private Discord community for those of you that do not know. If you are interested in joining the Discord community, there will be links on our Instagram link. Also, I'll try to see if we have links down below in this video, and I'll make sure to put it there as well. And I'm proud to say that over the past 5 years, my portfolio has consistently outperformed the S&P 500, using my own personal style, of course, of value investing. So it's not typically easy to do that, but I'm glad that we've come to this point where I have developed my own method to do things, and I'm happy to share those things with everybody here. So you can always reach out to me, and I'll always reply, especially on Instagram or Discord or anywhere else that you see fit. Okay. Just a little bit about EGA. We have a multi-tiered schooling system where you enter through a beginner level by taking the beginner's course, which is an overview of trading strategies, technical analysis, and options fundamentals. That means derivatives. And then the second step of our school is to actually climb into the technical analysis course, which gives you a good overall view of price action mastery for scalping, day trading, those kinds of skill sets which you will need during your day trading career, right? And then once you're done with those two courses, there is the advanced option strategy, where you can learn everything you need to learn about advanced premium selling, straddles, strangles, spreads in general, which make up the rest of the bulk, which is going to be the wheel strategy, and of course, how do you manage just a bigger size portfolio. Okay. And then everyone who graduates from these courses, they pretty much get into our Discord, and that's where you start to apply everything. People who sign up for the beginner and TA course, we currently offer 2 months free Discord subscription together with the curriculum and the school fees, so that you get to apply everything that you have learned in class during live trading sessions, which we hold on Discord regularly from Monday to Friday. Okay, there are obviously some days which we don't trade, but we are all about patience and building that discipline more than anything. And anybody who is in our private Discord, they will be able to tell you the same. Okay, so that's just a little bit of a rundown of EGA and me, and why you should care. Okay, so this is the agenda for today. We're gonna go over a quick U.S. market update. We're going to go over day trading in current times. I'm going to go over why day trading has changed, what has changed, right? And then also, I want to give you 10 lessons from 10 years of trading, which are psychological, mechanical, and mindset challenges. It's a really short segment. We'll also go over scalps, day trades, and swing trades. What are the defined category, like the defined things that you need, right? And then finally, we're going to close out this webinar discussing derivatives or options and their place in trading in the current world, right? How do you use options to their maximum benefit? A lot of traders join currently with the prospect of making a ton of money using options, but they don't really understand the concept. And so I want to drive this home today during this webinar, because these are all interconnected, linked things. So we're going to have a good balance of the macro side, the technical side. We're going to have a good balance of everything that's going to really help you to enhance your learning experience, to really get you on that next level. Okay. But right before we start, I would really truly appreciate it if all of you guys, there's like almost 30-40 of you guys here, if you would just take a second to smash the like button. If you can do that for me, I would really truly appreciate it. It's going to help the YouTube algorithm reach more people. And the more people that actually hit the like button, the more people are going to join, and that's going to give other people the opportunity to learn through us, right? And we love teaching, and well, personally, I love teaching, and I love the fact that other people can learn for free, and it's never going to be a barrier for us. EGA will never create a barrier for people to learn. There's a lot of resources on our YouTube channel that you can go and just access, and you will see that there's a ton of content that we have done in the past that will help you directly and immediately. Okay, great. Thank you so much. I really truly appreciate each and every one of you for being here, taking the time out from your busy schedule, and just attending this webinar. Okay, so let's try to have fun as we do this, and let's get started here so that we don't waste more time. So very quickly, a US market update, and I'm going to give you guys a quick post-mortem. So this is after the fact, what has happened and where are we heading after this. So this is the what has happened part of it, and just very quickly, I'm going to turn off my video so that you can actually read the entire slide, right? So very quickly, right, this is 2020, right? We had quantitative easing in record-breaking levels, right? So the Fed had almost done about $4 trillion worth of quantitative easing. And this gave rise to many investors padding up consumer savings. We had consumer savings at a record high during the COVID pandemic, right? Record household investments. In case some of you don't know, some of the biggest investors in the US stock market are US households, okay? They're US households. They actually make up about 29% of the entire market for investments, okay? This is literally like research done by FactSet and Bloomberg, right? And so during this time, we also had equities that were pretty much supercharged, right? Why? They were businesses that were supercharged into digitization. So during the COVID era, right, about 2 years ago, a lot of businesses were forced into digitization. Why? Because everything was moving online, right? You can't, you can't go have a brick and mortar business so easily anymore. So a lot of businesses went online, they did things online. And this caused really record sky high valuations for various speculative tech growth stocks, right? Some of which were Zoom, some of which were all the cloud tech, right? Even stocks like Microsoft and Amazon saw really, really high valuations, even the bigger mega caps I'm talking about, right? And this was exactly when exuberance kicked in, right? With fears of a prolonged COVID situation, investors and traders were starting to price in the fact that a lot of this valuations would drag on for a longer time, right? And rightfully so, we had this going on all the way into 2021, right? So in 2020 and 2021, the stock market rallied almost double digits for 2 years straight. It was 28% or 29%, and then 23% in 2021. We had 2 straight years of excellent growth in the markets in terms of return on capital, right? And this is exactly when like stocks like Zoom hit $400, right? Peloton and the rise of all of these other COVID boom stocks, right? Then we had right at the get-go, right? Don't forget this. Everybody keeps shitting on the Fed, but right from the get-go, when this happened, the Fed iterated the possibility of prolonged sticky inflation, right? They said this very early on. They said, hey, we see it coming, but we're going to take a reactive stance to it, right? They said we're going to do a reaction stance. We're not going to do a preventive stance, we're going to do a reaction stance. But then they reassured the market that, okay, the economy is robust enough and we'll be able to survive this period without suffering considerable setbacks. This was the narrative of the Fed, okay? Shortly after this, in 2021, remember 2021 in January, February, March, we saw the supply-demand shock, which was supply-demand shock headlines, right? It was a lot of, oh, what's going to happen now? We have these supply and demand chokes all across the world because of COVID. We had a mass unemployment, and then we had a mass troubled time for frictional unemployment, which is people losing their jobs and trying to reallocate their time elsewhere, right? This was a big problem during COVID, right? Because people just didn't want to work in general. They were getting stimulus checks. They were getting all kinds of money. That was $4 trillion was a stimulus that was floating around the economy, right? And that money had to go somewhere, and they were mostly being padded down into savings, consumer savings. So people were saving money because they were very uncertain about the future, right? And this supply-demand chokes, as an effect of the shutdowns, caused inflation to spike, right? So then inflation started going up, and the Fed said, whoa, 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 whoa. It's starting to get a little nasty. It's starting to get a little out of hand, right? And this is how the whole thing started, right? Then in 2022, we had the oil shortages, which were perceived shortages because of a breakout of war between Russia and Ukraine. And at the same time, you had complications with OPEC Plus, which is the oil-producing petroleum companies around the world that control oil supply, right? From Abu Dhabi to Mexico to the US to Russia, they're all part of OPEC Plus, right? And what happened was, do you guys remember that during COVID, oil prices plummeted, right? They went almost to negative. They did go to negative, right? In fact, people couldn't even buy enough oil because they were like, nobody wanted it, right? They were also scared, right? And this was a perceived shock. It wasn't actually something real, right? And now what's happening is the complete reverse. Now things are moving in the complete opposite direction. So now oil is super expensive, right? Why? Because now there is a perceived scarcity, right? So this is how the typical market moves, okay? We move from exuberance to exuberance. Move from an area of speculation to move to an area of fear. The fear and the greed constantly kicks in. So then the Fed stepped in right now to cool down the economy by reversing the flow of credit. This is now their talks about the rate hikes that have been going on for a while during high inflationary times. And the market has started to speculate that the Fed may have been too late to do so. So now exuberance is kicking in the other way in reverse, okay? So it's really important to see where we have come from, right, in order to understand where we're about to go, right? This is what I personally think is super important as a trader. You need to be able to visualize and understand, okay, this is where we came from. Now, what is likely to happen, okay? Now, there is a few scenarios that I would like to entertain here. And that is, the first thing is the Fed's big bluff, okay? Now, there is something very important to note over here. And that is the fact that no matter how much of stimulus and run off on the balance sheet the Fed does, they are not going to be able to achieve the quantitative tightening that they actually truly want. Okay? Now, why do I say this? This is a report posted by, I believe it was JP Morgan, okay, or Goldman Sachs. It's either one of them. And I want to highlight it to you guys because I found it very, very interesting and very important, okay? So it says, beware of the Fed's pawns, right? Once again, the Fed is whispering into the ear of journalists over the weekend, saying the Fed is so the journalists reported saying the Fed is set to start shrinking its $9 trillion asset portfolio. Their plan rhymes with the 2017-19 version, but this time will be different. They're going sooner and faster, all while preparing a speedier pace of rate increases because inflation is high. Now, the interesting thing here is if the Fed really pushes on this string too tough, they are going to break something, okay? And the bond market signaled this for the past couple of months. Almost for the past 4 months, the bond market has been signaling, and that's the reason why it has been selling off in disdain, right? The bond market has been like, yeah, no, you guys aren't going to do that, right? So it's just pretty funny that the Fed went to a $50 billion a month in September of 2018 and then had to stop 5 minutes later in December. And this was all after promising Wall Street economists that they were on autopilot all the way up to a 2 trillion reduction. You guys don't remember this, but this happened in 2018, okay? And now they're going to try and take away 90 billion, right, a month, starting from May, and then do back-to-back 50 basis point hikes. It seems improbable, right? It seems improbable. And this is what the market is jittery about, okay? This is what the market is jittery about. Now, we talk about valuations is a completely separate thing. Why the market is falling is a completely different thing. That's a basis of the Fed, yields on bonds, and then how that conversely relates to discount rates, and how discount rates affects valuations of beta stocks, right? High beta stocks. But it's interesting here. So read this, right? Who are they kidding, right? It's the worst start to the year for stocks in decades. Consumer savings is down to the bone. GDP printing negative, and the Fed is going to kick off a record tightening cycle. This would be the record tightening cycle for the Fed in many, many years, right? So the idea here, or the perception here, is that this is a perceived show, kind of like the Fed saying, we're going to do this, and then watch the market naturally suppress inflation through their own mechanisms, right? So if I told you, for example, if you do this, I'm going to hit you, you probably wouldn't do it, right? So that's kind of, they're kind of dangling the stick in front of everybody, and they're saying, hey, you better not do this, like, you know, inflation's high, y'all better start, like, you know, controlling the prices of things, right? And so it's really interesting because we can see that the US dollar has been climbing for the last, I feel like, you know, couple of months, right? And now we hit a technical resistance, and this is going to create some relief pressure on equities as well, right? So we'll get into that in a second as well. So right now, the main, the main asset classes that are going to benefit from this scenario are, of course, going to be the hard assets, right? So things like gold, silver, platinum, uranium, and then of course value versus growth stocks, right? Growth stocks are not the beneficial thing to look at right now, and of course emerging markets, because when you have the dollar so high, it makes more sense for other countries to trade against the U.S. economy. Okay, and then of course we have the Treasury, right, which also can't really issue that many bonds right now because the price of bonds are so low. So they kind of have to, very, very carefully orchestrate this. Now, I also want to point out that the TLT, which is the bond proxy for the 20-year plus Treasury, the 20-year, so anything on the fat tail of the bond market, is also going through what we call a bullish divergence. Okay, it's a bullish divergence, which is interesting because remember that bonds and equities typically move in opposite directions, but this time we're seeing them moving in cadence. So continued here, you can see that the dollar index has also seen a technical resistance at the same level multiple times through the years, going all the way back to 2016, right? And right now, if you realize, we actually bounced off this level, right? We actually bounced off this level. Let me just show you real quick. So we actually came pretty close, right? And now we're starting to come down here, right? This was the reason why equities were also kind of selling off, right? More expensive dollar means dollar denominated assets become more expensive, right? So you don't want to overpay for something. So when the dollar gets more expensive, stocks become less attractive because they're more expensive, right? So that's one example of another reason why we don't expect the Fed to continue its bluff. They're bluffing, but there will be a limit to the bluff, right? So that's one interesting thing that you guys should know. So that's a little bit of a postmortem and / US macro update. I hope that is somewhat helpful. This scenario is more probable than most scenarios out there, in my opinion. It's much more easier for the Fed to bluff because nobody's going to fight the Fed, right? And when they do, it's going to naturally cause asset prices to deflate, which is what is happening right now in the stock market, right? So they can say that they're going to do something, and then whether they actually do something to that degree would be a different thing. This is the reason why they never forecast ahead, right? They always say, yeah, we'll probably do 50 basis points for the next foreseeable future, and then we'll do this and do this and do this in the future. But they'll never talk about those things. They will always give you only what you need to know for this moment, right? So it could be a change in the way that things go in the next couple of months. But remember, the stock market prices in the most extreme scenario, right? That's how things work. Exuberance works in that way. So everybody starts to get more pessimistic, and that causes valuations to be really drained. Okay. With addition to that, let's look at a little bit of statistics. Okay. So looking at the internals market breadth in the U.S. stock market, and then also the S&P 500 statistics for provided by Sentiment Trader. This is after falling to a 20% discount. How does the S&P 500 perform after that? Right. These are all interesting statistics that you should know. So looking at the S&P 500 after where we fall a 20% discount. The chance of there being a positive return after 1 week, 2 weeks, 1 month, 2 months, 3 months, 6 months, 1 year, it's all more than 50%. But whether we get there is a different thing. And the last time that these happened, after 1 year, there were only 2 times when the market was actually down instead of up, right? Which was 2000 and 2008, right? So now it's TBD. We don't know what would happen, right? But the average median performance was a 30 point or a 30 percentage hike, right? And the deviation of this score for the 2 weeks to 1 month for the Z-score is higher in the shorter term than it is in the longer term. So longer term, there's more, there's more probability that it will be a success rather than the shorter term for this information, the data set, right? Not to mention we have almost every single sector being oversold at this point, right? Except for energy, right? And then as of 1 week ago, we had neutral on consumer staples and energy, and then oversold on everything else. So almost everything is oversold at this point, right? Nothing is really trading in a phase where we have even sideways movement. Everything's just sold off, right? And you can see that stocks outperforming bonds. We now see that stocks are coming back to the mean reversion of where stocks are typically trading in cadence with bonds. The mean level is right here, right? So we're coming back down there. And then, of course, you can see that we are peaking out of the extreme oversold, which was last week. This is based on the 50-day moving average spread. And so these are, just internals, right? Internals of the market. So percentage of overbought stocks versus oversold stocks is very, very crazy, right? And PE ratios are down pretty drastically, as well as dividend yields, which are also dropping, right? Yeah, so that's a little bit about everything here. And then, of course, you have bonds and commodities here. If you have the euro bond, yen bond, the 10-year yield. You have gold, silver, which are both oversold, as well as copper. And then crude is overbought, as well as gasoline and natural gas, which we know is happening all across America right now. I think gas prices are pretty crazy there, like $6, right? That's pretty crazy to me. I remember gas prices being at $4, and I was like, damn. And like now it's at $6, and I'm like, whoa. Okay. So that's your little macro technical update, right? And right before I get into the lessons here, I want to talk about day trading a little bit. And I want to talk about how it has changed through the years, right? So I think that, you know, day trading in the current times has, ever since I started at least, right? We didn't have access to so much information, first of all, okay? Right now, there has been a rise of various different services, platforms. We went from a period of having very little information about everything to the current period where we have too much of information about everything. So one of the biggest problems that I feel day traders face in today's world is oversaturation of information, is decision paralysis. You have too many decisions in front of you and you just don't know how to make the right one, okay? This is where having that very defined purpose of knowing exactly what you're good at comes into play. Now, the other thing is, in the past, it was far more easier to be a day trader than it is right now, because the oversaturation of these tools have also given rise to algorithms. They've given rise to a lot of different machine learning and just AIs that are trading on big companies' behalf. This has all given rise to lots of positioning by market participants that is kind of making things a little more difficult. Now, tell me how many times, right? Answer this question for me in the chat really quickly. How many times have you guys taken trades as of recent times, right, where you take the trade and it immediately turns against you, not even giving you a chance to recover from it, all right? And you know that you waited for the right steps. You thought that you were doing the right thing, right? But all of a sudden, just like you followed the steps of confirmation too, it just immediately went against you, right? How many of you have gone through this scenario, right? I can guarantee that some of you have. And the current market situation, which is very erratic, causes a lot of over speculation, right? So the more volatility increases, the more speculation gives rise. And the more speculation gives rise, then you start to see like, oh man, this is terrible because, you know, I'm not able to find any direction in this market at all, right? That's what's been happening as of late, right? And when things like that happen, you absolutely need to take a step back and stop what you're doing, right? You take a step back and stop what you're doing, because it's so difficult to move into the next level if you are constantly just harping on getting into the trades every single time, right? So what are 10 lessons from 10 years of mine? And I'm going to share these with you because these are, I think, very fruitful lessons that I have learned over time, right? Number one, before you start your trading, make sure your mind is clear, right? Make sure you clear your head. Make sure you eat something light, and make sure you do some breathing exercises. I can't express to you how important this is, okay? Now, trading is a very intense, high bandwidth profession, all right? Not having some, like anything sugary or not having anything in your body that's processing food in general is gonna disallow your brain to fire off neurons and get the optimal performance that you want, okay? Your brain uses glucose to create those electrical signals that it does, okay? And you might not realize this, but try it the next time. Try to eat something before you start trading and see how you feel, okay? It's gonna really change the way that you do things. I personally think like it has helped me a lot, and so I'm giving this information to you. More importantly, try to breathe, calm down. Don't stress about yesterday. take yesterday's performance out of the window and concentrate on today's performance, right? No matter what happened to your P&L, okay? Which brings me to my second point. You do not need to trade every day, okay? This is one of the biggest mistakes that traders make in our current times. They sit in front of a computer hoping that something's gonna happen, okay? If you can't trade and walk away from your computer every now and then, meaning to say you're even during your trading session, if you can't walk away from your computer, you are doing something wrong, okay? There is something seriously wrong. It's either you don't trust yourself or you're not setting proper safety nets for yourself. But whatever it is, it's causing you a lot of anxiety, okay? So stop thinking that you have to trade every day. This past 3 weeks, I must have taken like less than 10 trades, okay? Last week was such a slow week because I just didn't want to force anything. And this week, like today we took a couple of trades, but like as a team, but like not really that much of risk taking neither, right? So let the trades come to you rather than you chase them, right? Now another thing is many of you concentrate on your dollar P&L per day, okay? You concentrate on dollar P&L. How many of you are guilty of doing this? Like seriously, there's 30 of you here. Tell me how many of you are guilty of your P&L levels dictating how you concentrate on whether you are having a successful trading day or a losing trading day. Green P&L, like in terms of dollar, and you're like, oh yeah, this was a great trading day. Red P&L, and you're like, oh, this was a bad trading day. How many of you do that? I'm going to tell you right now that your trading day should not be dictated by your P&L, okay? It should not be dictated. When you get stopped out of a trade, remember that that is a successful intervention of your risk management style. You have to be proud of yourself when that happens, okay? A lot of people look at getting stopped out, they associate a negative emotion with it. How many of you think this way? I guarantee you that you guys think this way, right? You know how I know? Because I used to think that way. Whenever you get stopped out, you automatically think like, oh man, like that was a bad trade. Oh man, like I made a boo-boo. Oh man, like why did I get stopped out, right? This is a terrible way to build a healthy trading habit, okay? Remember that your P&L doesn't dictate how successful you are as a trader. What dictates how successful you are as a trader is your risk management style and how much of risk to reward ratio you are aiming for a trade, okay? And we teach all of these things in the beginner course, clear and simple, and then we hammer it down in the technical analysis course as well, right? So when you're looking at your performance, one of the simplest things I can tell you is turn off your dollar P&L and concentrate on your percentage win and loss, okay? Concentrate on just the percentage win and loss. Stop concentrating on the dollar P&L. The dollar P&L is going to get you into trouble a lot of the time, okay? Now here's another one. If a scalp or a day trade does not go your way in the first few minutes of taking it and it immediately breaks down, cut the trade, okay? Good trades, especially scalps and day trades, do not take much time to work. You will realize this. Whenever you take a good trade that is moving with momentum, it is a burst of momentum in the market, and within a few minutes you see the effects of your P&L shift, okay? When I say P&L, I mean percentage P&L, not your dollar P&L, right? Remember that. If something doesn't go your way and then it immediately breaks down, cut it. You can always re-enter later. Even if you made a loss temporarily, completely fine, right? Observe your stop loss. Don't just let your trade idle, all right? Of course, I've said this so many times now, always have a plan, right? If you get into trading on Monday and you just turn up and then you're just looking around, you're like, okay, what's happening? Like, oh, what's going on? Like, and you didn't do any prep. My recommendation to you is not to trade that day. If you didn't have time to do your homework over the weekend, you didn't have time to chart, you didn't have time for anybody to help you with these things, right? And you turn up on Monday with no prep at all, well, unless obviously you're part of the Discord community, that's what I do for everybody, right? I digest everything over the weekend, and on Monday when you come in, I basically tell you what's up, right? That's the benefit of being a part of the community, right? But if you don't do that, and then on Monday you turn up and you're kind of just helter-skelter and you're just looking for opportunities, but you can't really find them, then you are for sure setting yourself up for failure. I guarantee you that, okay? Majority of day traders in this current times, they turn up on Monday, like 30 minutes, 1 hour before the market opens, and they're expecting to hit home runs. And just think about it for a second. Do you not work, like if you go to your regular job, do you not prep for your job? Like, do you not think about work sometimes and you think, okay, what do I need to do on Monday? Like, this is what I have, this is my agenda, look at my calendar, plan my day, blah, 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 right? You have all those things to do naturally, right? So if you're day trading, you got to treat it like a job too, right? It's kind of like going to school too. It's just like you got homework to do, right? If you turn up on Monday and then you don't have anything done, what do you think is going to happen? And then the other thing is, none of you actually plan before the market opens. If you see setups that you like, are you actually actively setting up your active trader, like your options chain, so that you don't have to go finding all these contracts when the market opens? I've told everybody on the Discord multiple times that it is really important for you to shortlist the contracts that you think you're going to take and save them. Brokers offer this as a service, like you can save the trade. And when you're ready to take it, just fire, right? You're going to save a lot of time, even if you need to select multiple strikes, multiple expiries. But this should all be done pre-market. You should select them. And then when the market opens, you can confirm, looking at the open interest, looking at the implied volatility. Okay, these are all the things that are now matching, right? This is something you have to you have to do. Then the second layer, it's not only just enough for you to do these things, you need to confirm that your trade is actually a valid plan, right? So let me give you an example. We were looking at Caesar Entertainment today, okay? And this is just a brief example, right? Technical breakdown from, we were looking at this level here, but this breakdown of the 46.27 level was going to see us move into the extension down below based on the Fibonacci extension of this big wave, right? And we were looking for a further extension down into these levels here, which coincide, with the previous support levels. Now, many traders would get trapped here and take the short position right away. This is one of the things where I often like to make sure that I wait for a confirmation. What does that mean? That means we want to see the breakdown, the supply continuing to be overbearing here, right, versus the demand. And then we want to see a pullback and a retest of this level, right? We want to see a retest of this level, but also another rejection of this level. And then only then can we take the next leg down into the 23 and the 38.2 extension. So this is an example of confirmation, okay? An example of confirmation. Now, number 6, there are an abundance of trade ideas every day, and it is your job to be scrutinizing the finest setups with the best RR, risk to reward ratio, and that is what is going to make you profitable, okay? Nothing else. Yeah, if you think that just always relying on scalping is going to make you profitable, or one specific strategy is going to make you profitable, none of that is going to work. You can go and learn from the best traders in the world, but at the end of the day, it is your risk management style that is going to get you profitable. There is no other way around trading, okay? You can learn what bounce strategy, breakout strategy, this strategy, that strategy, learn how to use options flow and still do badly, okay? This is one thing that traders are constantly doing. They overcomplicate their trading strategies, right? And then they end up with jumping between strategy to strategy. It's like, oh, this works for this guy, let me try that. Oh, this guy is a millionaire trader, and he uses this specific strategy. Let me go learn his strategy. You end up paying for something, and then you try it on your own, but because you have different risk management style from that person, completely disastrous, right? And then you jump into another strategy, and you keep jumping and jumping and jumping until you're just fed up with yourself, and then you're like, you know what, day trading is not for me. versus just putting your head down and actually concentrating on the risk management instead of concentrating on strategies. That would have got you much, much further, right? Understanding what risk is and how to manage it is a very, very important part of trading, okay? It's one of the basic things, like it's the basics, basically like the first 1 or 2 modules on the beginner's course is you'll be learning about risk management, right? And then number 7, taking breaks after big wins is as important as taking breaks after big losses. Now, many of you probably do not do this, but I'm going to tell you that this is super important. When you have a big win or a big loss, you have to take breaks, okay? Super important. Walk away. Don't, like, even if it's a big win, walk away. Because you need your brain to reset the cognitive bias that is in your head. You will now be acting on autopilot with a newfound ego. What I call it is an ego reset, okay? When you lose, your ego takes a hit. When you win, your ego inflates. They move in opposite directions. So you need to be able to reset and come back to baseline, okay? So when you have a big win, take a break, all right? Take a break for the day. Come back tomorrow. Try it again. This is not a game where you are a one-hit wonder. This is a game of consistency, and this is a game of being disciplined, right? And then number 8, don't overcomplicate your trading strategies. Keep it simple. Reduce the noise by using less indicators. I don't know, some of you have your screens looking like a laser light show from a rave, right? And rely instead on price action and index cadence. These are more powerful than you would imagine, right? I've said it so many times, even on the beginner's course. Just by understanding index cadence, right, you can come up with the best trading ideas, as long as the market is directional. If the market is non-directional, just don't even bother, right? Because no one's going to make money in a non-directional market, especially if you're trading derivatives, right? So concentrate on keeping it simple. Stop overcomplicating, okay? Number 9, cutting your losses is as important as taking profits. So you can only keep winning if you are prudent with risk management. I don't think I need to say much more here, right? When you're taking profits, majority of you get greedy and you let it run longer and then you end up in losses. How many of you go through that? I know that you do, so you don't even need to tell me. I know that you do. You see 30%, 40%, and then you're like, oh no, it can go higher, it can go higher. 50%, 60%, oh no, it can go higher, it can go higher. You don't take any profits, you just let it ride. Next day, minus 40%. Boom, you're like, what the hell happened, right? Happens, okay? I know it happens. I've been there. Have the very important discipline that when you reach 30, 40, take some off the table. 50, 60, more off the table, right? Let a few runners ride and make sure that the runners are not a big chunk of your capital, right? That means you're running with free money, okay? Whether you win or lose, doesn't matter. That money wasn't yours to begin with. That's the way you do it, right? And lastly, lesson number 10, if you feel anxious and you can't stop looking at your phone through your trading session, or you can't use a toilet, or you can't have a meal, or you can't walk away, right? You are probably applying too much risk. There's a very high chance here that you're applying too much risk, okay? If you get constant anxiety about these things, there is a very high chance that you are applying too much risk. A trader who is applying the appropriate amount of risk is able to walk away from the computer, walk away from wherever they are, and they could even just walk away for the entire day and not care about what's going on. If there's an emergency that comes up, this person can leave and not worry about their trading account, okay? That is comfortable risk. That is the risk you should be taking. Anything above that makes you uncomfortable, that's the wrong amount of risk. And this is just the best way for me to explain it to you, okay? So if you can't walk away from your computer and you can't go do something else like go for a walk down in your park, or go get food, or go cook a meal, or go take a shit, right? If you can't do those things and let your trade run, there is something wrong with your position sizing, all right? If you constantly, like, even while you're cooking, you're looking at your phone, what's going on, what's going on, what's going on? Something's wrong with your position sizing, all right? Because it just means that you have risked too much and you can't afford to lose even a tiny fraction of that, okay? That's the reason why your brain is in hyperdrive trying to make sure that everything is okay. All right? So these are 10 lessons from 10 years of my trading career, and I hope it helped you. Okay? I hope it helped you. How are you guys doing so far? Everybody can hear me and everything good? If you can, take a second. If you're new here, smash the like button. I really, truly appreciate it. And let's move into swing trades, day trades, and scalps. So I want to go through the basic blueprint, right? The basic blueprint of trading. Now, this is a very big summarized version of what you're going to learn in the beginner's course, and we go through this in major detail on what you're actually going to be applying, right? The way you're going to be applying all of this is going to make a big difference, right? For example, for scalps, right? There are two schools of thoughts when you're approaching a scalp trade. Typically, majority of traders go 1 to 2 strikes out the money, right? In terms of the options trade, right? But there are two schools of thoughts. One is a delta focused trade, and the other is a gamma focused trade. Okay? There's no right or wrong answer. It's what you choose, what you think is right or wrong. It's subjective, right? Options trading is subjective to begin with. We tend to go for a delta focused trade when strikes are not available adequately. What does that mean? I'll give you an example. Exhibit A, where you have the Apple options chain, okay? And the idea here is I want you to pay attention to the strikes and the way that they go, right? So these strikes that are near the money, they have a lot of liquidity, and so there are more people willing to sell options at these strikes. But the further you go out the money, you realize what happens. The strikes start to get a little wonky. This, instead of being $1 out, like $1 increments, they start to go like $2.50, $2.50, $2.50, $2.50. Now, if you were expecting Apple to move $1, right? And then what happens instead is you take a trade that is $2, like $2.50 strike out the money, but you don't expect Apple to get there because there is no resistance in that area or there's no liquidity in that area. Then what happens is you're forcing yourself to take an option contract that is not within your range of target strike. This is one thing that kills scalps. Okay? It's a very basic thing that kills scalps. So choosing the wrong strike, basically. People tend to go either too out the money or just, if you go in the money, it's not really a big deal because I personally prefer paying more for the additional delta, right? You stack more delta in the process, you get a more profitable trade. Sure, you risk a bit more, right? But majority of traders end up getting this part wrong because they choose the wrong strike. And that's really the part which gets quite terrible, right? Now here, we don't care about expiries. So the guideline is generally you can take a weekly expiry. But on a Friday, you want to be really careful. If you're not an experienced trader, I don't recommend you trading weeklies on a Friday, right? It's going to really wreck you if you do that, okay? And you want to stick like 1 to 2 strikes out the money, depending on where your target range is, right? And then you can choose, based on your strategy, based on what you think is the strikes are available for that ticker, you go for the delta focus, which is when you have strikes that are not provided adequately, right? That means you go closer in the money. Or when there are a lot of choices, like how I just showed you with Apple, you can go for the more gamma focused trade, which is going to be slightly more out the money, 1 to 2 strikes out, right? So this is the gamma focus example, 1 to 2 strikes out the money, right? You want that gamma acceleration, basically. Remember the way that delta and gamma move, right? It's like this, right? So this is your gamma curve and this is your delta curve, right? This is delta, this is gamma, right? So gamma and delta, at the money, gamma is the highest and delta is about 0.5, right? So you got to remember that the acceleration of gamma is at peak when you're at the money, beyond at the money, okay? And when we talk about scalps, right, another thing that traders often overlook or they have problems with is the overbearing need to constantly chase something that's moving up. Okay, now I personally like to scalp on a 5 minute because I like that time frame. It helps me to visualize things, right? Like for example, we're looking at Pfizer here, right? And Pfizer's really in a nice little falling pattern here. Looks like, you know, it's bounced off a couple times on this strong trend line, and you know, we're waiting for this break above and hold above to start getting into these higher levels up here. We're waiting for the price action to give us the signal, right? One thing that traders do as a mistake is they start to scalp on the breakout and then they get faked out into it. This is another thing that requires confirmation. So for example, for Pfizer, I really would like to see a bounce only above 54.18, which is this level here, right? Above this level. And so we can start to put some alerts on the way there, right? And then we want some $56 calls for next week, right? Around this level. And put in those notes, because if you set an alert and you don't know what the heck you're supposed to do next, it's pointless, right? Write stuff in your notes, right? My recommendation, right? Go shortlist the contract that you need, right? Go look at it, right? What is the open interest? What's the volume? Don't do all that later. Do it now. That's my point, right? And then check on it tomorrow again. Note what the open interest is. Note what the volume is, right? If you're going to scalp it, okay? These are like basic things that you have to do, okay? Don't just turn up and then expect things to be done, all right? It's not going to work, guys. Do the research to find out what's going on, right? If you don't look at the things and figure out what's going on before you get into there, then you're like turning up and then it breaks out and then you take the contract. You're not going to notice fine details that change. For example, what was the open interest yesterday? What was the open interest today? Very important stuff, right? Because the open interest, if it dropped, means that there's lesser interest. There are less traders betting on the upside. The momentum might die down, right? So really important, okay? And then of course, with day trades, the guideline is you want Monday to Wednesdays, you can play the weeklies, Wednesdays to Fridays, next week expiries, right? The next week. And we also typically go for a gamma focused trade here, right? Because we have multiple waves. And here you really need that risk to reward ratio structure, right? How do you plan? How do you do all that? That we teach this in the beginner's course. And then you need that volume breakout. More importantly, you need to understand what volume is. It doesn't necessarily mean, right, that volume up or down means good or bad, right? Like these volume bars on the bottom, they don't tell you anything about whether it's bullish or bearish volume, right? If you guys don't know, just note that this does not tell you if it is bullish or bearish volume, okay? It doesn't tell you that. Green doesn't mean bullish. Green and red doesn't mean bearish. It just takes on the color of the candlestick above it, right? And then you want to play the wave or the pullback here, right? So there is another thing between day trades and scalps that I wanted to mention, which is a specific time period during the day where premiums get crushed. This typically works with stocks that are gapping up or gapping down, okay? Give an example. So, for example, we look at Caterpillar here, right? And let's say, I'm just giving you real world examples here. So in case you're wondering, this is our teaching style during class as well. So I like to put in real world examples so that we have a good amount of things that we can discuss. So for example here, Caterpillar gaps up at the market open 2 days back, or when was this? 23rd? 23rd. Yeah. So Monday, right? It gaps up. And typically when we see a gap up like this, this is continued momentum is expected, right? This is what we call a continuation gap. This is not a breakaway gap. This is a continuation gap, right? Because you're continuing up into between two ranges, right? That's the range here. And typically what happens during this kind of a gap is you have an area where some profit taking will occur. And that is actually a really good spot to enter a trade long most of the time. Okay? So there is a moment, what I'm trying to explain to you is there is a moment, okay, where during a scalp and a day trade, or when you're planning for these two, where premiums get drained, the IV gets drained. And you know, it typically happens the most with like stocks like Tesla, right? Typically a stock like Tesla will see crazy amount of premium drain because it's very volatile, right? And when that happens, that's a good spot to go in and grab those contracts for the low. So let's say Tesla dropped 6-7% today, right? You could have gone in and picked up some of the destroyed contracts on the weeklies, right? Because everybody's overly pessimistic, right? That's just an example that I wanted to give you. It's part of a strategy, okay? Now, with day trades, you want to play the waves, right? It's more of a structured, patient approach, right? Where you're looking at a 15-minute chart, you're looking for those waves, right? You're waiting for rejections and impulses. Rejections and impulses. If something's trending down, you follow the trend down. If something's trending up, you follow the trend up, right? Until that trend breaks, right? So with Tesla, you still have a downtrending a stock here, for example, right? You still have the downward trend. You might have some little fake outs here, right? And retests, but this is still a downward trending stock, right? For example. Okay. Follow the trend, don't get lost, okay? Very important. And then lastly, you have swing trades. And swing trades, we typically look for contracts 60 to 90 days out. It used to be 50 to 80. And now with the way that the market is trading, we want more time. And we look at a strike price that is typically halfway to the target from our entry point. And there's a reason for this. We teach it during the beginner's course. We want to aim for a good mix of gamma and delta, right? And we focus on the direction. We do this by looking at the two-wave confirmation, which is not a specific multi-million-dollar strategy or whatever. This is just confirming that the trend is changing, right? When something moves from down to up, downtrend to uptrend, right? It typically moves in a wave-like fashion, right? And so when you have a downtrend, and then it starts to reverse out of it, you're expecting, right? Something like that, right? Or maybe there might be a sideways consolidation for a bit, and then a continuation to the upside, right? So for example, this would be the downtrend, and then a consolidation, and then we want the kind of a breakout, right? And then higher highs and higher lows. This is what we call the two-wave confirmation. This is the first wave and the second wave. And we are typically waiting on a 15-minute to see, okay, this is the two waves that are confirming that the trend is indeed reversed here. And this gives us a directional play, okay? Now we get into these details all in the course. This is too much to mention in one webinar, okay? But I'm giving you the gist of it. I'm giving you what you need to know, all right? So these are the meats and bones of what makes up your day trading style, right? These types of trades, these are the main ones. Like these are the blueprint to be successful in all three of them, right? You want to really focus on hammering down, getting these things right. Because if you can get these things right, the structure of it, right? Of course, not to mention swing trades also have RR structure, but typically because you're trading at a pivot point, right? Like between two specific pivot points, right? If you're taking it either here or here, the RR is going to be superior anyway. It's easy to manage risk. Your SL goes either here or here for a long trade or a short trade, right? Long trade, short trade. So really easy to manage risk with swing trade, right? Now, derivatives, which is the last part of this webinar here before we have a special announcement. So please stick around for the special announcement. Derivatives, right? How do you use them to the maximum benefit? It's really something that, you know, we need to focus on, because I think a lot of new traders, they jump into options trading without understanding that it's a time-based instrument, okay? There are two things that gives a option its value. One is its intrinsic value, which means what value does it have left over at expiry, okay? And the second is time value, meaning to say how much time do you have till expiry. The time value drops off at expiry. Why does it drop off? Because of theta, right? That's time decay. So theta works consistently to erode the value of time value. And options traders typically miss this beat. They don't even look at the implied volatility, or they don't look at the open interest. They don't look at these specific things that are really important when you're choosing an options contract, okay? There is a lot to learn, and you know, if you don't do it the right way, you're likely to get burnt, okay? Now you have to understand the concept behind time value of money, and in options, it is the fundamental concept of understanding how other traders are betting on the foreseeable outcome. More importantly, you need to be able to calculate the intrinsic value of the contract, right? Which is the strike plus the premium, right? And if in that case you overpaid for the contract, then you're going to lose money. So majority of the time you will realize that you will end up losing money because of the fact that you paid too much for the contract. It's not necessarily about your timing sometimes. The timing is the effect of paying too much for the contract, right? So because you try to chase something up or you chase something down, that's typically the reason why you're going to lose money, okay? So I want to keep it real with you guys. Don't get yourself into this mess. Now, market conditions are really tough at the moment, okay? This is the time where you scale down your trading, scale down your risk. Take less risk right now, right? In a market like this, you want to really be risk off, and you want to deploy your capital in the right manner when the right time comes, okay? So don't concentrate on running into trades and trying to speculate and, oh, this is happening, that is happening, this is happening. Don't even listen to the news, the headlines, because they're going to be fear-mongering and they're going to just cause you additional anxiety, okay? I want to take this moment to really tell you that it's not easy to trade in these current times. Even for me, right? I'm also experiencing the same difficulties that you are. But the only difference is I have experience under my belt to know better, to not force my trades, to not force something that is not going to work, right? And for that reason, I take very few trades these days, and I wait for the market to become more directional, right? Remember, when market's non-directional, you can't trade options because sideways movement is what kills options contracts. You need direction in order for momentum, and then momentum to build gamma or delta. Yes? So if that happens now, don't chase, okay? Don't do anything. Okay, so special announcement. First things first, I want to mention very quickly that this is going to be the last waves, 34 and 35, which are going to be live classes, all right? Where the beginner course is going to start next week, 5:30 to 6:03, and TA class will be 6:13 to 6:18. All live classes, 3 hours per day, 9 p.m. EST to 12 a.m. EST. If you're in Singapore, it's going to be 9 a.m. to 9 a.m. to 12 p.m. I believe. Okay. All recorded, lifetime access to the recordings, and of course, you're going to be putting everything that you learn into live trading sessions, which will be a part of your learning experience. And this is going to be, for example, this was just last week, right? This are all the trades we took last week. So every week you're going to be held accountable to what you have done. It's going to be a very different wave this time around. Okay, we are pivoting the structure of our school, and so this is going to be the last waves of live classes that we are holding. All right, and I'm really excited. Actually, I'm super excited because I'm really excited to share with you guys the new direction that I'm taking EGA into. There's going to be a slew of new courses that are going to be arriving in the future, but they are not going to be like the beginner and TA course. Okay, so the beginner and TA course will be around, but they're going to be repurposed into something else, which is going to be far more exciting and much more. Well, it's going to take a while though, so it's going to be probably the end of the year. Okay. Now, till then, this is going to be the last wave of classes that we're holding. So if you want to learn the basics of fundamentals of trading, the fundamentals of trading plus technical analysis, this is the time to do it, right? We'll be putting everything together with live trading sessions, and then following up with lots of technical guidance. More importantly, so this is you know, the summary. You can view this on our Instagram as well. What the courses are about, right? Oh, and there's only going to be 20 seats available, just so you know. Okay. Only 20 seats available. Every single student is now going to have one-on-one mentorship with me. Okay. So there's going to be one-on-one coaching sessions with me in this wave. Every student is going to go through one. All right. In this one-on-one sessions, we are going to focus on the key boundaries that are keeping you from being profitable and fix them, right? And notes will be provided at the end of the session, okay? And the session is going to be recorded and sent to you for your own comfort viewing, all right? It's basically going to break down your key psychological problems, anything that you're fixing in terms of technical analysis or trade execution. And also, if you want to do portfolio analysis, I can do that, okay? So there's a whole bunch of things that comes with the course, not to mention the Discord access, which is already worth a lot of money. Okay. So exclusively for this webinar, we're doing a special promo, and this webinar is not going to be available after this. We will only be releasing the webinar maybe after this promotion ends. So this is 24 hours. These codes are 24 hours valid. EGA 20 off is going to give you 20% off both beginner and TA course. Okay. And if you're getting the bundle, which is the day trading mastery bundle, it's going to be 30% off, and you can use EGA 30 off. Make sure you write these down, because the webinar is not going to be available after this webinar ends. Okay. I'm going to be privating the video because I want to be fair to the people who are here and want to take advantage of this special promo deal that we have here. Okay. For everybody else, you'll pay. If they're not here, then they're gonna pay the full price and stuff like that. Okay. So this is going to be the promo that we're holding for the courses, and I wanted to just make sure that you guys hear the special announcement before any of y'all left. But yes, the webinar is now over. I hope that you guys found it useful, and thanks for watching. We'll see you in the next one, probably next month. We'll be holding another webinar. If you have suggestions for the next webinar, drop them in the comments, what you want to see us discuss. Perhaps it could be anything. Maybe you want to learn how to do fundamental valuation, or you want to learn anything else. Drop in the comments what you think our next webinar should be about. And in the meantime, make sure that you write these codes down in case you are planning on joining the tribe and the beginners and technical analysis course this coming weeks. So I hope to see you in class, and I thank you for spending your time, taking your time out of your busy schedule, being here. Truly appreciate you guys. I love you all. I miss YouTube, and definitely want to come back to doing more content on YouTube, and I will be doing so in the next couple of months. Okay. Excellento. Any questions? I'm going to stick around for a couple minutes here in case you guys have any questions. And yeah. Post any questions you guys have, and also make sure you take a photo or a screenshot of the promo code so that you have it with you when you're signing up. No problem, guys. Definitely fundamental analysis. Okay, cool. Well, I see, let's see, with regards to the T class, I have a work, okay, let me read this real quick. With regard to the TA class, I have to work in office 1 day a week. I would really hate to miss one class. What are my options with that in mind? Dustin, so thanks for the question. To answer that question, the solution to that problem is to watch the recording and then get on the one-on-one session with me and then have your questions ready. And I will answer everything in that one-on-one session. So it will be like a private lesson between me and you. And that way, you'll be able to really focus on the content that you missed and make sure that you understand everything that you missed from that one class. You watch your recording, and then you will get on the one-on-one session with me and discuss exactly what are the things that you don't understand from that lesson, or anything that you have, any questions that relating to that lesson. So you will not miss anything, because if you need be, I will take that time during our one-on-one to go through the part that you missed. Does that answer your question? Thank you. I would be interested in hearing your perspective on markets, perhaps monthly. Sure, we have things in the works that are going to be very close to what you're mentioning. So I can't release the details just yet, because it's a very big release. It's EGA version 3.0, and I want to make sure that we have all the details before we get that out to you guys. But trust me that there will be at least once a month updates going on from the next couple months. Okay. Have taken day trading courses before, but very interested in your content. Will next set of courses be cheaper? Can't make it for live lessons. Unfortunately, this is the last time that these prices are going to be available. Anything that comes after this is going to be more inclusive, because our curriculum and the modules are going to be more jam-packed. So they're not going to be cheaper than this. I guarantee you that much. Okay, I can promise you that the courses are not going to get cheaper than this. Definitely not. The thing you want to really take advantage right now of is this, the bundle. Okay, if you want to really take the maximum out of this last wave, and right now it's going for the bundle, because it's never going to be this price ever again. Okay. Let's see. Can you review open interest and how you use it to select a particular contract? Sure, Nick, I can go through that. What are the monthly costs for Discord following the course? So you get 2 months of access with the Discord. And following on, when you take the courses, then you will get a 15% off coupon that is perpetual. So it will be 15% off the Discord subscription. I believe it brings it down to around $100 per month. If you use the 15% off coupon with the yearly subscription, it brings it down to $90 a month. Okay, so I always tell people, if you're planning to stay with us for more than 6 months, which you should if you really want to take it seriously, this is the reason why we take pride in having, as very few people in our Discord, and we pride in having a very concentrated community. There's no bullshit in our community, so it's all just traders who are very serious, who are trading together. We don't have people shouting random things on the trading floor. It's a very structured trading floor, and we only discuss serious ideas on there. Then you should go for the yearly, because the yearly is going to make more sense. It will be a longer period of time for you to get used to everything and apply everything that you've learned through the courses in the real world context through the live trading sessions. Existing members of the Discord who are here, if you're in the chat, please tell Dustin how that works. If you can say something, it would be great, right? I think it's best when people hear from other people who are in the community rather than just from me, right? So it depends on what you go for. I want to say about 70% to 75% of the content is going to overlap, and we're going to be focusing on other kinds of content as well, included in 3.0. But remember that 3.0 is not going to come until the end of the year. So if you don't want to wait that long, and you want to learn right away, then this is what you want to go for. I'm once again reiterating that this price is never going to come again, and you will be getting the content at a discount. And it's going to be accessible for lifetime, right? So that's what I'm saying. You should go for this right now. I'm giving you the saving. If you don't want to go for the saving, then, and you want to wait for something more expensive that is going to be more comprehensive in the future, then that's kind of the choice that you have to make. But there will be 25% of the modules which are going to be new, and 75% of the things are going to overlap, but they're going to be redesigned. They're going to be redesigned. So our curriculum is in a major redesign mode, okay? Because after 2 years of teaching 35 waves, we are making updates to majority of the things that we need. We're looking at all the content, stripping it down, and we're making sure that everything is where it needs to be, so that students can really make a nice transition between going for that learning and applying. That is the main thing. The live courses are going to give you the real world application. That's the main thing that you will never get again, right? So this is what you want to go for. I'm saying it again like 4 times now. This is the best thing that you can go for right now if you don't want to wait 6 months. Just saying. Okay, so just to answer your question, HRF. Okay, did I answer majority of the questions here? Remember, you're getting both of these courses for a major discount here. So this is really something you should consider, okay? It will be both beginner and TA. And this is something that will never come again. So my recommendation, this is what you should go for now. Whether you want to go for the module in the future, that's a different thing altogether. And then we will be making those individual modules also available. So you can definitely go for a discounted option and then have parts of the other modules in the future as well. Okay. All right. Any more questions? Okay, so I want to answer the question from Nick. So he said, can you review open interest and how you use it to select a particular contract? Okay, great question. So let's review a little bit about open interest. So open interest is a measurement for the amount of open contracts in any particular derivative, right? So for example, we're looking at Apple and we're looking at the weekly expiry, and let's look at Apple chart real quick so that we can have a real world application for this, right? So Apple came down into the dual zone on like yesterday, right? 20th May, and it says the coupon doesn't work for technical analysis. EGA 20 off. There's the word off as well. See? Off. EGA 20 off. OFF. Make sure it's all caps. EGA 20 off. And then this is EGA 30 off. Make sure you put the word off. So going back from Nick here. So using open interest to look at what's going on in the market, right? Looking at the technical levels here, we don't know if Apple has bounced yet, right? For example, we could continue to see Apple slide, but let's see where the action is at. So open interest gives you a good idea of where the action is at, okay? And so let's look at the skew. The skew. What is the skew? The skew here is where majority of the open interest resides. The 150 calls have a lot of open interest, a lot of people betting on those. And then next up is the 145 calls, which had the highest volume of trading intraday past this trading day, right? On the put side, we had 135 puts that were being traded the most, and then 140 puts being traded the most. This was the highest volume traded and open interest. So looking at the open interest here, you can see that a lot of the action is concentrated here, 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 and here, right? Okay, you can see that. So 145, and then 150, and then 140, and 135. This is on the put side. This is on the call side, right? So the option traders are betting in both directions, right? So 140, 145, and then 130, 135, right? So they're betting downside and upside. Based on the technical formation intraday, we still see rejections, and then we're still seeing further downward movements, right? That means that we still don't have a confirmation. We need to see Apple break above 144, for example, 145 here, right? For this level here, and then to see the upside slide into 148, 149, right? Around this region here, right? We want to see this upward movement if the upside is the right trade. If we want to see the downside move, then the rejection has to happen at here, where we are right now, right? 140, which is right here, which is the intraday level which we got rejected. So depending on what happens to the market when we open up here, right? The other rejection level would be 140, 144, right? So this is the reason why if Apple continues to trade range bound here, we don't want to take anything until unless we break below this level here, right? 136.47 or 136.45. So now we have our intraday range, right? So this is where the price action is residing, right? So a break above this level here, 144 roughly, or 136 something, right? This is the intraday levels. It's going to be a break above, bounce, and then upside, or break below, bounce, and then downside, right? And so if we're betting upside here, then we want to look at the 145, 146, 148 strikes, 150 even, possibly, right? If we get a strong rally. More than likely though, we want to go for the 146, 147 strike. that will be about 2 strikes out the money, right? Remember, day trade or scalp. If you're looking for a swing trade, completely different setup altogether, right? So now we go back into the option chain and we have a look at what we were looking at. So the upside trade, we won 146. 146, not that great, right? So 145 is the one that you will select. This is where the action is at, right? Now, as long as open interest remains below 50,000, still okay to trade. The moment it hits above 50,000, 40,000 in that range, where you have open interest very high, like around 30,000, 20,000, I tend to stay away from these contracts because they're too overcrowded, right? Not also mentioning that the implied volatility is important. So that's another thing you need to consider. So where the action tends to be is around here. You could choose any one of these strikes, but this is where likely that majority of traders will provide a lot of liquidity for you to get in and out. So if you're taking a scalp or a day trade, this is the contract you want to trade for the upside. For the downside, let's look at it again. So downside, we wanted the break of 136, and then we want to play down into 133, right? Where was the action there? 135 was the action, right? But we will avoid 135 here. So likely, what we want to do is go for something closer to the money. And if we want to go something closer to the money, then we can possibly take the 138 puts. Because this has the highest volume traded and decent open interest, right? 50,000 volume traded and then 9,000 open interest. And tomorrow we can see if this improves. So we'll see. Tomorrow at the market open, we'll see if this changes from 9,000 to something else. And that's how you're going to tell. If it goes from 9,000 to 20,000 tomorrow, that means there are a lot more people betting on the 138 strike for the puts, right? So all of this information is pertinent, okay? And that means that you could take the 138 puts on the break of 136. That would be in the money strike. And that means you're betting on the delta acceleration down. You'll have very little gamma here. I hope that's somewhat clear and helpful in understanding how we plan this trade sometimes and choosing the right contracts based on open interest and volume. Did I answer your question, Nick? So we go through these in great detail during the beginner's course. If you want to learn further, like how you should be taking advantage of these things, I highly recommend that you take the beginner course. Even if you don't want to take the Day Trader Mastery Bundle, go for the beginner course because it's going to teach you these things. Okay, and then of course, how do you measure the risk to reward ratio setup for this entire trade, right? Where do you put your stop loss and those kinds of things? They're all discussed in the beginner's course. All right, excellent. I hope I answered your question. And I'm going to end the webinar now just in the interest to keep it, short. Great, Dustin, appreciate it. We'll see you in class. And remember, there's only 20 spots, guys, and these are going to go pretty quickly. So I've only put 20 signups available. And I hope that I'll see you guys in class. All of you will go through the one-on-one session with me, so I'll see you guys when I see you guys. Take care in the meantime, and I'll see you guys in the next webinar. Watch out for announcements, and we'll see you in the next one. Peace.